All right, let's jump right in. We're talking about something that's become a huge blind spot for a lot of high-earning Indians abroad. It's a hidden tax trap you could walk right into without even knowing it.
So, you're living abroad, maybe in a zero-tax country like the UAE or Bahrain, and you're probably thinking, hey, as long as I'm out of India, my Indian income is totally tax-free, right? Well, you might need to think again.
For the longest time, the rule was super simple, right? The magic number was 182 days. Just stay out of India for that long in a financial year and boom, you were officially a non-resident Indian, an NRI for tax purposes. Nice and easy.
But then, everything changed. A new law back in 2020 completely shook things up. It brought in this brand new concept specifically designed to catch high-income Indian citizens who, well, aren't really paying taxes anywhere else in the world.
And that, my friends, brings us to the core of this whole thing. So, what is this hidden trap? It's a brand new status called a deemed resident.
Okay, so what does that even mean? A deemed resident is basically an Indian citizen who India decides to treat as a resident for tax purposes. And get this, even if you haven't spent a single day in the country that year. The whole point of this rule is to target folks who aren't on the hook for taxes in any other country.
So, the big question is, could this be you? How do you figure it out? Well, let's walk through a really simple but totally non-negotiable checklist.
Okay, listen closely. You become a deemed resident automatically if you check all three of these boxes. It's not one or two, it's got to be all three. Number one, you're an Indian citizen. Simple enough. Number two, your total income from Indian sources is over 15 lakh rupees in a single financial year. And number three, you aren't required to pay tax in any other country because of where you live. Places like the UAE, Bahrain, Oman, that kind of thing.
All right, so let's say you tick all three boxes. What happens then? Well, your tax status goes through a massive change. You're no longer just a regular NRI. You become something called an RNOR.
Yep, that's right. If you're a deemed resident, your official status becomes resident but not ordinarily resident, or RNOR for short. It's kind of like a hybrid status. It means India sees you as a resident for some tax reasons, but it also acknowledges, hey, you don't actually live here full-time. It's this special little category with its own unique rulebook.
This table really lays out what it means for your wallet. I mean, your Indian-sourced income is still taxable. That's no surprise. But check out the differences. Indian dividends, they used to be taxed at a nice flat 20%. Now, they get taxed at your personal slab rate, which means the more you make, the higher the tax percentage. And here's the real kicker. If you have foreign business income that's controlled from India, that suddenly becomes taxable in India too. The good news? Your foreign salary is still safe. So that's a relief.
Okay, that's all theory, but let's make this really hit home. Let's look at a classic real-world example. We'll call it the case of the Dubai landlord.
So picture this. We've got an Indian citizen who lives and works in Dubai. They're earning a cool 18 lakh rupees a year from a rental property they own back in India. During the year, they spend about 130 days in India, way less than that old 182-day rule. And naturally, living in the UAE, they don't pay any income tax there.
All right, let's run them through our three-point checklist. Are they an Indian citizen? Yep. Is their Indian income over 15 lakhs? You bet. 18 lakhs is definitely over. And are they on the hook for taxes anywhere else? Nope. They live in the zero-tax UAE. So check, check, and check. All three conditions are met. No doubt about it.
So what's the bottom line? That entire 18 lakh rupees from their rental property is now completely taxable in India, and at the higher slab rates too. That is a huge tax bill that just a few years ago wouldn't have even existed for them.
Now, if any of this is starting to sound a little too familiar, you're probably asking yourself, okay, what do I do now? So let's talk about that. How do you navigate these new rules? The first thing that comes to mind for most people is, wait a minute, what about the DTAA, the Double Taxation Avoidance Agreement? Can't that save me? And that's a fantastic question.
And the answer is, well, it's complicated. Look, a DTA, like the one India has with the UAE, can absolutely help. It might give you lower tax rates on certain things, maybe on interest or dividend income, but, and this is a really big but, you don't just get these benefits automatically. Claiming them is complex. It requires a lot of careful paperwork, and it is definitely not a do-it-yourself job.
Okay, let's quickly recap the key takeaways here. First, that old 182-day rule, it's not enough to protect you anymore. Second, if your Indian income is over 15 lakhs and you're in a zero-tax country, you are absolutely in the risk zone.
Third, your status changes to RNOR, and that messes with how your income gets taxed. And finally, and this is probably the most important point, this stuff is not simple.
Which brings us to the most critical piece of advice, and you'll hear this from every single tax expert out there. To better understand your tax obligations as a deemed resident, you should get in touch with your tax advisor. Seriously, this isn't just a friendly suggestion, it's an absolute must.
Look, the rules of the game have totally changed. The last thing you want is to get caught by surprise with a massive tax bill. So if you take away just one thing from all this, let it be this. Don't guess, go get professional clarity on your specific situation. It's really the only way you're going to navigate this hidden trap and come out on top.